Well, I think the edge comes from an appropriate mix of art and science. So I think investors need both. You can't run an investment portfolio purely on quantitative indicators. Sometimes they will give you missed signals. It's like trying to fly a plane, lots of indicators up there that will help you, but if you don't have a bit of art in there, a bit of skill in there, you could get things wrong. But likewise, you can't run the portfolio purely on judgment, on art. You need indicators to sort of indicate when things are getting too extreme. So I think the edge that we have is the experience that the team offers, particularly Nader, myself and others in the team, have seen numerous cycles through our careers, and I guess the skill in terms of being able to apply that to the indicators we're seeing to give you an appropriate mix in terms of the asset mix through time, and that's, I think, what gives Dynamic Markets Fund, or DMKT as we're calling it, the edge. Well, I guess first a bit of history. The process we use solely focused on asset allocation, because that's what DMKT is all about, had its genesis in AMP diversified funds that Nader and I have been managing and doing the asset allocation for many, many years. So the underlying process, the allocation process, DAA process we call it, dynamic asset allocation process, had been honed over many years. The first stage in that process is to look at indicators of medium-term return potential. Then we look at what you call DAA indicators. We look at valuations. We look at where we are in the investment cycle. We look at liquidity indicators. We look at sentiment, and we look at technical indicators. And we combine those, and then out of that we construct a portfolio. And then of course there's a weekly meeting, which sort of, I guess that's where the art comes in. And of course there's daily discussions between Nader and myself and others. So that's basically the process in a nutshell. But each week we update our indicators, and then we have a rigorous discussion about those indicators. Now, a lot of the time nothing will happen. Things don't move that much, and we don't consider ourselves day traders. But I think it's important to go through that discipline of regularly updating your indicators, keeping an eye on them, and having at least a weekly discussion about what they're telling us. One of my titles is Chief Economist, but I've long worked out that you can't just rely on economics. In fact, if you just rely on economic forecasts to run your investment process, you'll go way off the rails. I mean, just got to look at economists' forecasts for the exchange rate for the end of each year, or the share market for the end of each year. They're often way off. So you've got to have some fundamentals in there. So the economics is important. You've got to have some fundamentals in there, valuations, but you also need to admit that things like technicals do give you some edge. Now, some people might say, well, sentiment is part of that, but I think technical indicators, whether you're overbought, oversold, breadth in the market, and obviously drilling down a bit further, that also helps. My experience is that technical analysis and indicators does add a lot of value, but the trick is combining the two, the fundamentals and the technicals together, which I think really gives you the value add.